Hello everyone, welcome to Just Invest Today. And today we have a good video for you guys. Today we're going to be talking about an investor called Walter Schloss. And Walter Schloss was an amazing investor. And guys, I like to go back to see what the best investors were doing back in the day and how we can kind of like find gems and apply it till today. And Walter Schloss was actually cited by Warren Buffett as a very good investor. In 4 decades and a half, he earned around 15 to 16% annually over 4 decades. So those are amazing results. And compared to the S&P, it was like 10%. And during some of those periods, he was earning 20% annually. So you can see this guy was a very good investor, and he's under the Ben Graham tree of investors. So when we know about these Ben Graham investors, this whole group did very well in the stock market. So it's good to go back to see what they were doing, how they did it, and take some rules, because there's always something that you can take from the past and apply it till today. So let's get into Walter Schloss, how he started, what he did, kind of rules that he set in place so we can become good investors. So Walter Schloss started on Wall Street in 1934 at 19 years old as a runner. And as a runner, he took courses under Ben Graham, so he learned a lot about value investing, and then he actually signed up to go to the war. So when he came back, Ben Graham really wanted him under his tutelage, and he wanted him to actually become an investor. So he became a security analysis under the Graham-Newman partnership. So during that whole partnership, he actually met Warren Buffett, and Warren Buffett had so much amazing things to say about him down the road, as he actually wrote about Walter Schloss and how he was actually mentioned in the Super Investors Grams and Doddsville article, talking about all these group of super investors under the Graham partnership that became amazing investors. We're going to look for what he said about Walter Schloss and the good things he said about him. Buffett wrote about Walter Schloss saying that he knows how to identify securities that sell at a considerably less than their value to the private owner. And that's all he does. He owns many more stocks than I do, is far less interested in the underlying nature of the business. I don't seem to have very much influence on Walter, and that is one of his strengths. No one has much influence on him. When you think about this quote about Walter Schloss that Warren Buffett said about him, you have to understand how his mentality of the Ben Graham partnership kind of influenced his investing practices. Because remember, he was under Ben Graham, and Ben Graham was influenced heavily about the Depression. When the Depression killed his stocks, he lost so much money, like more than 50%. A lot of his partners were actually coming out and taking money out of the partnership. So that had a big influence on Ben Graham's investing style. And then that changed his whole mindset, that he was just going to find companies selling less than working capital and then wait till they appreciate. So basically, getting companies that are cigarette butts, they have one less puff in them, and we're just going to hope that they go to the intrinsic value, or hope they reach that intrinsic value, and then sell them off. So that was his style, and that's the kind of style Walter Schloss tried to emulate, but he had to do it a little bit different because it was a different time. When he started his partnership in 1955, companies weren't selling like that anymore. So he had to adjust the style, and he came up with philosophies, he came up with strategies to help him kind of get close to Ben Graham's style, but still adjust for today and how the market was shaping back then during the 1955, 1960s, 1970s era, right? So that's why we're going to look at what he did, because he had huge returns, around 16% for 4 decades. That's amazing. Your money's going to compound very fast if you can actually keep that, and you're beating the S&P by a lot. So let's see what he did. Let's see how we can figure out some interesting things that he learned and questions to ask yourselves. Walter Schloss and Ben Graham had very strict rules when they were buying undervalued companies, and they stuck to them. So when you're buying these undervalued companies, you got to look at working capital or book value. So when you're looking at working capital, you take the assets and then you minus the liabilities, and then you get the net worth of the company, and then when you get that net worth of the company, you minus the debt, and that's what you get with the working capital. But those are hard to find. So when we're looking at companies with book value and see how much they were selling for on the market compared to that book value, and he only wanted undervalued companies. And the thing about these companies is that you can't predict where they're going to go because they don't have a solid earning growth. They're all over the place. So the thing he does is he makes sure he buys a lot of these undervalued companies. So it's almost kind of like the magic formula, acquires multiple, stuff like that, right? And when he did that, he thought about actually buying companies like you're buying groceries, not like you're buying perfume. So that means that when you're buying groceries, we want the lowest cost. We want those companies, those food that's going down in price. We don't want the food that's going up in price, and that's what we're looking for. So when you get these undervalued companies, you got to have good judgment. You got to be kind of sure. And if it goes lower, you still got to be very convinced. You got to go be contrarian and still buy when it goes cheaper. And that's what he was doing that during that whole 1955 when he started his partnership. So there's a few questions, and he has a few answers to these questions that I thought were really good in this kind of interview article that he talked about. So the first question during this interview starts article was, how come all the Ben Graham disciples are seem to be successful investors? And he answers this question by just saying, we are able to stay rational. And when he says that, he just means that we're able to stay level-headed during market ups and downs. And we're not overly emotional to our investments or to what's going on in the market. So that's what we need as investors, to stay rational, level-headed, and don't get too attached to your stocks, because one day you might have to sell it because an investing reason, something bad happened to the company, and you're so attached, emotionally engaged into that company, you don't want to sell it, even though you know it's something bad happened to the company, something bad's going on. So don't get too emotional with your company, and you got to stay level-headed, rationals. So when we're staying rational, we're making good decisions. And then he also mentions being honest. And this being honest is that you're going to surround yourself with good people around you that are actually going to help you. And when you're honest, you're going to probably attract other honest people. So you're all going to be making good investment decisions together. So that was the first question someone asked him. And then the second one was, has his investment strategy changed? And he said yes, because we're unable to find those companies selling below working capital on the market, because those companies were selling during the depression time, so he had to adjust his strategy. And what he's doing is he's trying to find companies that are selling at the all-time lows. And that's what he's trying to do. Companies selling at the all-time lows, companies with problems happening because they don't care about their earnings maybe next quarter or next 2 quarters. They're just trying to find undervalued companies that actually are selling kind of at book value or a little bit below book value. And they can see those stocks appreciating over time. You just gotta give those companies 2 to 3 years to appreciate, and they will. So that's what his strategy was. And that's what he sees. Like, he sees that when these companies are undervalued, and we can kind of see that, like, there's a potential for a boom, like a short-term problem, like not becoming a problem anymore, he starts investing when they're at their lows. And he buys a group of these companies. So I feel like we can use this strategy. Like, in my opinion, I like this strategy, but I'm still sticking to the long-term compounders, not touching them, doing all that type of stuff, and not thinking about those companies. But I feel like we can kind of do this strategy when there's going to be a huge downfall, or when we kind of have money on the sidelines and there's still companies selling below book value or at book value, and we can just kind of have our money into those companies. If they appreciate in like 1 or 2 years, we can just sell them off and make that quick money over there. And then we have our other companies that are long-term compounders that are gonna explode year after year after year. So we have to have those two different mindsets if you're gonna use this strategy. So that's what I might be doing in the future, finding these undervalued companies. And I know I don't want to keep them long term. I just want to hold them for 2 years, maybe 1 year, and then sell them off when they appreciate in value. It's a good thing about learning about Walter Schloss, and because I had a company called Big Lots, and it was selling at a 1 PE, and I should have bought it. I knew I should have bought it. It was like $44. I was about to make a video on it, and I just passed it because it's undervalued. I only think about companies that are going to grow long term. But this could have been a quick play for me, a safe, quick play. And now it's at like $62, and now it's like a 3 PE. So just looking at that and how I made that quick mistake because it was just undervalued and I didn't see growth in the future, even though this company had a good return on equity, good return on investment, it was still making money, and it was selling at like a 1 or 2 PE with actually good revenue. So like, and not a lot of debt. So I just passed on it because I just thought there was no potential for huge growth in the future. So now I'm going to start looking at companies that are like selling undervalued, that have a little bit of potential, that may be dealing with a short-term problem. And this, in my mind, I know I can make a quick buck from that, making like a $1,000 profit or whatever I have kind of profit in that company. Walter Schloss came up with 15 factors in order to make money in the stock market. But I'm going to go through a few that I thought were very important for the strategy if you want to use it to make that quick money kind of, and find those kind of undervalued companies that are going to be sold in 1 or 2 years. So let's go through some factors. So number 1, price is the most important factor to use in relation to value. Number 2, try to establish the value of the company and remember that a share of the stock represents a part of the business. It's not just a piece of paper. Number 3, use book value as a starting point to try to establish the value of an enterprise. Be sure that the debt does not equal 100% of the equity. Number 4, have patience. Stocks don't go up immediately. Number 5, don't buy on tips or for a quick move. Let the professionals do that. If they can, don't sell on bad news. Number 6, don't be afraid to be a loner, but be sure that you are correct in your judgment. You can't be 100% certain, but try to look for weakness in your thinking. Buy on a scale and sell on a scale up. Number 7, have the courage of your convictions once you've made a decision. Number 8, have a philosophy of investment and try to follow it. The above is the way that I found to be successful. Number 10, when buying a stock, I find it helpful to buy near the low of the past few years. A stock may go as high as 125, then decline to 60, and when you think it's attractive, 3 years before the stock sold at 20, which shows that there is some vulnerability in it. Number 11, try to buy assets at a discount than to buy earnings. Earnings can be changed dramatically in a short time. Usually assets change slowly. One has to know more about the company if one wants to buy earnings. So there you go. There you have it. If you're trying to buy companies that are undervalued, focus on the assets, not the earnings, because the earnings are unpredictable in the long run or in the short run because we don't know, because the company's dealing with problems. So guys, tell me if you like this video. Please subscribe to my channel, like the video, and I'll get back to you in the next one. Peace.